Capital, one of the leading multifamily agency lenders, including programs from Fannie Mae, Freddie Mac, and HUD. Welcome, Colin. It is a pleasure to have you on today. Why don't you give us a brief background of your career as well as Hunt's activities?
Thanks, Anton. Very nice to be here today, and thanks, Faraz, as well. Yes, Colin, Hunt Real Estate Capital. I've been in the business since 2008, all in multifamily finance. Previously with a different agency lending shop and with Hunt Real Estate Capital and our predecessor companies for the last 8 years here in Dallas, Texas. Focusing primarily on, like you said, Anton, multifamily financings through the agencies, Fannie Mae, Freddie Mac, and HUD, as well as with our new acquisition of our firm from Oryx USA, who is our parent company now. They have access to a large balance sheet that we're able to do floating rate bridge, transitional bridge lending, as well as mezzanine financing for multifamily, and a few other unique products, occasionally some JV equity or pref equity positions as well. So kind of all across the multifamily space, and happy to be here today and talk to you about what's going on right now.
Glad to have you on, Colin. We've definitely done a lot of deals with you, and you're definitely one of the easiest, most reliable guys to work with. So definitely a pleasure to have you going.
Thank you, Faraz, and you guys are great as well. So appreciate it.
So maybe let's kick it off, right? 2019 versus 2020, right? Let's kind of maybe get ahead and just go straight to the elephant in the room, right? Kind of we're obviously late 2020, right? Near in the fall, and what has been kind of, I guess maybe my question is really ultimately, what has been the difference, right, with what Fannie is starting to position kind of outlook, kind of forward looking, and what requirements are they starting to really put in place and things they're starting to dig into?
Sure. Yeah. Amazingly, on the agency front, it honestly hasn't been that different of a year when it comes to kind of their volumes and what their focus has been. Over the last several years, they've had their federal regulator that has kind of been overseeing everything for them and managing their cap numbers of the amount of volume that they can do, making sure that they're focusing on affordable housing business that drives, that B and C apartment space and that renter pool. And so this year they already had their caps in place from late last year, and they have $80 billion each for Fannie and Freddie to hit for this year. And if you look at where they are year to date right now, I think Fannie Mae just came out with something fairly recently that as of August of this year, their total volume of loans closed was 43.1 billion, whereas in 2019 they were 45.2 billion. So and I think Freddie Mac has said that they're pretty much in the same position or so. So really, at the end of the day, they're kind of in the same position they were last year. Obviously, COVID and the market shakeups back in March and April really kind of set things off on a little bit of a different path in that, the interest rate environment was really what has been the driver behind all of that business that they've been able to do through kind of this recessionary period. And so, but in terms of kind of what their focus is, it's still affordable housing, it's still mission-driven business. It's still making sure that they're working with great sponsors who have good experience and are out looking at good deals and putting good money behind their deals. So from that perspective, really things are kind of the same as they have been with the agencies, and that's been nice. Obviously, as other sectors have been in a bit of turmoil, borrowers are able to have a little bit of that clarity that they're able to always rely on the agencies.
Yeah, so high level, they're still doing deals, right? I mean, it sounds like really about 5%. It sounds like is where they're off in terms of relative to last year and total deals done. But maybe to kind of distill it down, right, for the listeners, what can people see today on, let's just say you're doing a straight regular Fannie 10-year note, right? What can people see in terms of, IO, leverage, and interest rate?
Sure. Yeah. So,
and what are you seeing currently, right? It's maybe that.
Well, yeah. What we're seeing currently is that, back in March and April, there was a little bit of I would say, a pushback from the agencies to say, okay, acquisitions, obviously, as we all know, were pretty much off the table at the time. No one was really transacting on anything. So the focus was, I think at the time, it was close to 85 or 90% of the business that they were doing was just straight refinances, because you were seeing the interest rates drop from, mid to high threes that were in January, February, March, down into the high to mid twos at the time. Things have settled back in kind of in that plus or minus 3% range here recently on what we consider to be full leverage type of deals, which would be, plus or minus 75% on an LTV, a 125 debt cover. On a 10 or a 12-year term, you can usually look to see, 3 to 4 years of interest only on the 12s, maybe 2 plus or minus 2 or 3 on a 10. But again, all of that is really based on kind of how the deal underwrites, what the cash flow looks like, how much are you really pushing that cash flow to try to get to maximum dollars. And then that may be a little bit of a push and pull then with how much interest only you can get on those deals. But I would say on average, on a good refinance or acquisition deal, expect to get something in that 75% range and maybe a couple of years of interest only on a longer term fixed.
So that's still extremely good compared to any other asset class, right? So we always have to see it in perspective, right? I know a lot of borrowers are not happy about the tighter underwriting and obviously the principal and interest reserves that are now required. But at least you're still able to get very attractive financing for multifamily. So I think that's really always important to see and compare it with all the other asset classes out there. When it comes to the P&I reserves, do you see any kind of loosening that might be on the horizon, either from Fannie or Freddie?
Well, in addition to answering that question, maybe it'd be good for the listeners to explain, because the P&I reserve is the new thing that changed, right? In the past. So maybe if you can quickly explain what that is, what changed, and then maybe kind of continue on to Anton's question.
Yep, absolutely. So like you said, Faraz, that was the one big change that really came out of the COVID response, in addition to obviously, managing forbearance and evictions and things like that. On the front end, both agencies said, hey, we're doing a ton of refinances right now. We're probably going to push back a little bit on, your cash out back in March, April, and May. And they've kind of loosened off of that definitely in the last several months, where there's not any, significant restrictions like there were previously on the amount of cash out over your initial loan that you can get on a new refinance. But what has been implemented, like you said, is the principal and interest reserves. Previously, I think Fannie Mae even had some replacement reserve, extra reserves as well, that they've since gone away with. So right now it's just principal and interest, meaning on most deals, you're looking at anywhere between 9 and 12 months of your debt service payments that you would normally pay, as part of your monthly payments for your loan. The lender is going to look to hold back that amount of money at the closing table from the dollars that we fund out and put it in an escrow account, just to make sure that, if you talk about kind of what's coming up down the pike here, collections have still been a little bit off nationwide right now. Occupancies have been slowly dripping down a little bit as we go along the few months here. And so just in case that there is, a second wave or some other things start happening, obviously there could be volatility coming at the end of the year that we're all aware of. The agencies feel like this is a prudent way to have a little bit of funds set aside for borrowers to draw upon if they need them to cover, to cover any payment shortages that they may have. If all of a sudden you get some, some big move outs, or non-payers, we've obviously got an eviction moratorium we can talk about a little bit more later on, but that's, something that's trying to keep renters in place and trying to keep folks paying rents. But, just in case they don't, we've got that principal and interest set aside for borrowers to draw down upon. We have to keep it for about 12 months as an initial term. And then after 12 months, actually, I think it's now 6 months initial term. And then we start testing it after that 6-month period. And if, as long as your property is operating at the debt service levels that it was initially, then we'll start looking to release those funds back out to borrowers. So usually somewhere between that 6 and 12 month range, we can start taking a look at, releasing those funds out if the property doesn't look like it's going to need it.
So actually, I mean, I think there's not enough information out there about this specific point, right? About the P&I. So it sounds like 6 months is actually when you probably can release it if the property's humming. It sounds like 12 months is the back end of that. Is there any case you guys would go longer than 12 months? And as a borrower, if I intentionally just choose to not pay my note and then say I want to pay it out of the P&I, is there any risk to that, right? Is it just that I'm going to have to wait the 12 months, or is there any other ramifications to kind of be aware of?
Yeah, so really there is like a moratorium period, a lockout period where we don't touch the funds. The funds are just sitting there in the escrow, and they're there for you to use if you'd like. Even in month one, like you said, if all of a sudden you close on a deal, it's month one, you get in there, and it turns out you bought a deal, and the seller had been stacking it. God forbid it's not going to be the case, but had been stacking it with short-term tenants or something like that, and all of a sudden you get a bunch of big move outs, and then all of a sudden you're not able to make your payment on your loan. Those funds are there for you to draw on starting month one, that you can start using. The 6-month period is really the first point where we can just release funds based on the strength of the property operations in of itself. But really that 6-month period, especially on Fannie Mae deals, is kind of the beginning point for us to test what the operations have been doing. So really what we're doing is at the 6-month period, we're going to go and get the latest trailing 12, trailing 6 operating statements. And we're going to take a look at what the cash flows look like and say, okay, things are looking great. Things look like they're running at or above where we expected them to run at the beginning of the loan process. Let's go ahead and check it right now. And then we can start focusing on getting those funds back out to you, within the next quarter or so. I think is kind of how that's been playing out. Obviously, we're still very early in this, so we haven't had too many instances of this actually going into play. So we're just, kind of going by what the guidelines are saying. But to my understanding, that's how some of that will work. And then to what you said on as a borrower, if, you want to start, immediately drawing upon those funds to make a non-payment, those funds are available to you. However, when you come in to do that, there's going to be some additional information that the lender is going to ask you for related to, okay, explain to me what the situation is. Talk to me about why it is that you're going to start drawing down upon this and you're not able to make your payment. Do we need to discuss the forbearance options that might be available to you, in addition to drawing upon these funds? So it's not that you wouldn't be able to access them immediately. Really, it's more, do you talk to your lender? Does your lender talk to you and say, okay, how can we work something out here? And that's where, again, having a great relationship with your lender and the servicing folks behind the scenes is just critical in these kind of volatile times.
Yeah, so I think that the answer really is, right, yes, you can draw from it if there is a need, but don't just think that if you have strong cash flow that you just don't pay, right?
Right.
Yeah.
No, and then there's always a need. And I guess I'm just trying to understand, as a borrower, right, you're always looking at what all the different options you have are. And so that's kind of where that question comes from, because, there's always the case, and we've seen this, where you're doing rehab, the draw takes a lot longer. So now what are your options, right? Do you have that vendor continue to wait until that draw gets approved? Do you pay, what you would have gone your note and say, you know what, I want to pay it out of the interest reserve, kind of play that spread a little bit. But are there any negative ramifications of going, let's say you take forbearance aside, if you decide to go use the P&I, I mean, is it frowned upon, right? Are you looked at negatively on the next deal?
No, I mean, at the end of the day, that is your money as the borrower, and it's there as a tool for the lender to have a little bit more confidence that there is money set aside in case something were to happen. So at the end of the day, in our position, that is your funds. And we just want to make sure that when you guys are coming in to draw upon them, that we understand, okay, here's why. We probably have to make a note into our files of why they drew down and what they drew down. And here's why, we think that there's going to be a quick ramping back up that's going to keep the property operations running well. At the end of the day, we want the loan to keep, the payments to keep coming in. We want to have no part of getting involved in the day-to-day management or running on a deal. We want the borrowers to be doing that. And so really these are one of the tools that we can use to make sure that they've got that available if they need it.
All right, that's good to know.
Yeah, very good. Colin, you touched on that a little bit earlier with loans that were taken out maybe 2 years ago or so that have a little bit more of a of a stress point there if someone wants to refinance or sell a property due to the high yield maintenance that you're facing now. Now, naturally, when you look at new deals, then everyone still remembers that what they have to deal with on their existing deals with yield maintenance. And they, if possible, want to go with a little bit of a shorter term fixed rate or go with a adjustable rate program. Now, particularly on the Fannie side, I think we have bigger issues with underwriting floors and all that. So maybe if you could tell our listeners what are the options if someone doesn't want to go with a 12-year fixed loan that then potentially exposes them to a very high yield maintenance. And I think also, right, with larger deals, we have also to deal with that massive premium for a step down prepay. So certainly shorter terms and adjustable rates would be great, but maybe you can also explain to us a little bit what the challenges are in going in that direction.
Before Colin answers this, for those listening, definitely take notes, because this is where deals get made. And, I mean, we've been in the situation where we have deals that, we can make a ton of money selling them. We're just kind of stuck. You can't really refi. You can't really sell. It doesn't make sense for an assumption. You're kind of stuck. And so we are absolutely considering a lot more of these options moving forward on some of these deals, given just kind of the new interest rate world that we seem to be kind of staying in for the next several years.
Yeah, absolutely. It's been the hottest topic pretty much of the last 6 months. I think we've probably run more prepayment penalty calculations than we have anything else in the last 6 months. And every other month checking it now, what does it look like? Are we down a couple $100,000? Does that help make a deal work? But it's definitely something that, in the last several years, as a lot of new folks have been coming into the business and have been coming into the space, what they're looking for is, okay, I want the best loan, the highest amount of loan dollars and the lowest possible rate. And how is what's the best way for me to get that, just to start off with? And the answer was always long-term fixed rate, 10, 12-year agency financing with the yield maintenance as your prepay. At the time, the interest, the 10-year treasury was in the mid to high twos. And we're on the lending side saying, these are still historically low rates. You can't really imagine that if you can't make a deal work with a 4 to 4.25 all-in rate right now, where spreads are in the 100 to 150 basis points and treasuries are in the 2.5% range, then that's a great time to be borrowing money and long-term money, and you want to have that locked in case something does happen here. What's ended up happening, though, is just what you guys said, is that the treasuries have been the thing that's fallen off the cliff, down 200 basis points. I think we're at around 65 basis points this morning on the 10-year. And so as a result, those yield maintenance penalties from a couple of years ago have a huge run up. I mean, we're seeing some that are, 30% of the total unpaid principal balance of the loan, or maybe even higher, that are due. Yeah, exactly. That are due if you try to pay it off now, just 2 or 3 years later. Whereas, in a normal year, that would be, a couple $100,000 or, maybe a 3 to 5% kind of, clip on the UPB. So it's definitely something that's important right now. Anton, to your question, there's lots of different options that are available. But again, the question comes down to that push and pull of, are you trying to get the absolute most dollars and the lowest possible rate, and that's what's going to help make your deal work? Or can you maybe do something that's a little bit lower leverage, a little bit lower dollars, put some more equity in? And if you're able to do that, then all of a sudden, some more of that, some more of those other options start availing themselves to you as a borrower. So shorter term, the main thing to know is that if you're looking at a Fannie Mae loan, 10-year business has a 5% underwriting floor, meaning that on every single deal that we look at, we plug a 5% rate on your cash flow. And typically we want to see that be at a 125 debt cover ratio. Obviously today, interest rates are much lower than that. We're in the high 2s, low 3s on most of those deals. So Fannie Mae has allowed us to go down to around a break-even level or so on that 5% floor on, say, a 10-year, and that's the case all the way down the line. But the problem is that can work on a 10-year and kind of keep you in the same range of loan dollars as you would be just on your, current cash flow at a 125 debt cover and the actual rate today. You start going down in shorter terms, 7-year, 5.5% underwriting floor, 5-year, 6.5%, or maybe even 6.75% today underwriting floor. So the shorter term you go on those Fannie Mae deals, it's just a way for them, that floor is to kind of disincentivize that much volume to come in on those deals because they want to drive business to the longer 10 and 12-year plus deals. And so on that front, you got to make sure you're checking your cash flow, trying to test it at what those underwriting floors are. Assume that your lender can probably get a little bit of leeway off that 125 cover down to maybe, a break even 1.0 or a 105 or a 110, depending on the market. But, make sure you're plugging that in if you want to look at a shorter term type of hold period. And then just what, Anton, you were talking about earlier, declining prepays, they are available, especially on the longer term deals. If you're able to get and we can talk a little bit about green in a little bit, but for example, on a Fannie Mae deal, if you're able to get a green financing deal today, and that brings your rate down in the 2.5 to 2.75 range, well, then maybe you can still do a declining prepay for an extra 40 basis points or so on the top of your spread. And then you still end up with a rate that's in that 3 to 3.25 range. And you could still have, your deal work at the max proceeds you're looking for, but have some prepay flexibility on a step down basis through your term.
Yeah, but then there's the argument of, step down makes sense if you think rates will fall, right?
Right.
Now the questions are, do rates have room to fall further, right? That's one big thing. But maybe kind of step back a little bit and kind of recap for the audience, right? So with the financing, it's really a debate between, do I lock in long-term or do I give myself an option to exit sooner, right? That's what the big kind of decision plan is, and, trying to weigh the different options and the pros and cons. And so, with that, I think there's one other piece that I think you kind of, we talked about agency and what that looks like, right? Being able to get to prepay, et cetera, et cetera. What about floaters, right? And kind of, are you starting to see upticks in those? And, for a borrower, right, how does that protect the borrower, right? What can you do to protect it, maybe is the question. And, is that attractive or not, right? And what are the kind of pros and cons?
Yeah, and that's leads into perfectly. Yeah, the other option that's been available right now has been floating rate, adjustable rate mortgage loans, especially with with where LIBOR and I guess now we're transitioning into SOFR as the new index for most of that business. Those indexes are down in the teens right now, and so really you're getting all-in rates on that floater that's probably right in line or so with what you're seeing on the fixed rate long-term side. So if you want to have a rate, but obviously you're a little bit concerned about things going up in the next couple of years, because like you said, Faraz, there's very little room, honestly, to go down at this point. We've heard from economists recently who have talked about whether there can be negative interest rates here in the U.S. You kind of feel like that's going to be, that'd be a difficult situation to imagine right now. And so if you don't think that rates are going to run down right now any much further, then they've only got a way to go up. And so the fixed rate side obviously covers you on that front, but on the floaters, you get a little bit more flexibility. So normally what happens is you're on a 7 or a 10-year floater if you're doing one of the agency perm loan floaters, where you have a 1-year lockout after you close your loan, and then you've only got a 1% prepay thereafter for the rest of the loan term. And so on those deals, you've got the same issues on the fixed rates in terms of loan sizing. So on the Fannie Mae deals, you got to make sure you're managing on those fixed rate floors we talked about. On Freddie Mac deals, they're going to make sure they're hitting to certain low metrics as well, down to about a 1.0 to a 105 debt cover on whatever the floating rate is. But what you're really looking at there is, all right, can I get to the most proceeds that I thought I can, maybe be a little bit less on the floater than it is on the fixed. You might be able to match them, but then do I give myself a little bit more flexibility with that perm floater? And again, that's for deals that have cash flows that are already pretty stable. Occupancies are good. You've got that cash flow that can support, a 125 minimum coverage on your loan amount. Whereas on a lot of deals, as Faraz, we've talked about, there's still value add plays to be done out there. And so maybe a cash flow is not quite there yet on a deal. We've seen that in the last, call it 3 months or so, bridge and balance sheet lenders have started coming back into the fold, whereas a lot of them were, shut down during the, the big part of quarantine back in March, April, May. They're back now. They're lending, rates are a little bit higher than what most people were, used to previously. Whereas we were seeing spreads in the, mid to high twos over LIBOR, maybe, this time last year on a lot of that value add, call it 75% levered, maybe even up to 85% type of business. Today, we're seeing those spreads being somewhere in the mid to high threes, even into the low to mid fours over the indexes, because again, I think a lot of these lenders, these balance sheet lenders, did take some hits definitely as deals were in the middle of their ramp up period and the middle of their renovations right as COVID hit. So you're seeing a little bit more of a premium on the spreads there, but you're still able to get that business, and it's about the same as what it was before, right? 3-year terms with a couple of years of extension options if you need them. Normally you're going up to 75, 80, 85% on an LTC and LTV basis. And those rates are where they are. You can get out of it. It's interest only. It's non-recourse. Get out of it pretty much at any time, unless there's a very short spread maintenance period at the beginning. That's still business that we see, and we're actually doing some right now. And it's just, one of those things that's definitely a good option for folks.
Yeah, but I guess to me, there's just 2 additional things. So what can people do to mitigate, right? How do you make it more like a long-term agency, right? And really, that's question number 1 for those that have never done it, right? Mm-hmm. And I'm talking about the cap, right? So maybe you can explain that piece of it, and that's what that does, how that looks. And then the other part of that is, are you starting to see an uptick in people doing Fannie, Freddie floaters?
I think we definitely are, mainly because I think a lot of folks are not really finding that they want to go and take that, significant risk with a big value add that maybe is an 80% occupied, a 70% occupied deal, and they're going to be the ones who are going to ramp it up. I think what you're finding is that sellers are saying, hey, like, we still feel like the cap rate is good here. Rates are low. We don't expect that we should be able to sell this thing for anything lower than what we were maybe before. Whereas buyers are saying, hey, I think that there's a more inherent risk here for this profile of deal. And there's not nearly the amount of lending out there, debt options for me that there were 12 months ago. So I need to have, a little bit more of comfort that I'm getting this thing at a great price. And so we're not seeing nearly as many of those deals getting through on the acquisition side. And then to your question, as well on kind of what you can do to hedge and keep it as something that is more like an agency perm, those types of deals are really for the transitional, the bridge loans are for the transitional deals, the ones that need a little bit more time and seasoning to get to, 85% physical occupancy for 3 straight months that the agencies need, 75 to 80% economic occupancy, good, strong collection levels there. These deals are not those. And so those are ramping up a little bit more and need a little bit more time. What you can do though is as you were mentioning, is you can hedge, get a cap for the 3-year term, the initial 3-year term that you have on those bridge loans that can max out the amount of increase that your index can go up to. So if you're doing it based on SOFR and it's 15 basis points now, you buy a hedge that's maybe at a, 2.25, strike rate, call it. And that's the level that SOFR can go up to. And all of a sudden your cap kicks in and you're not going to have to pay anything higher than that. And so, like I said, if you've got, spreads that are somewhere in the mid to high threes and you've got a 2.25%, that the worst case scenario you're going to be paying is around, a 5.5 to 5 3/4 rate. And that can kind of give you a little bit more comfort that you're not going to get just underwater on rates running up on us.
Yeah, very good. So I think the message here is, right, if it's a property that's fully stabilized, that has a strong cash flow, you have, as a buyer or owner, you have two options, right? You go with a fixed rate that is a long term, and you may get a little bit higher leverage there. But if you want to have that flexibility, you can go with an adjustable rate program, but more likely than not, you will have to accept a lower leverage, right? But at least the options are there, right? When it comes to the bridge side, obviously until COVID-19 hit, the bridge market was extremely active. There were a lot of players that came into the game over the last few years, and then everything collapsed, as we know. Now, you with a very strong backing from Oryx, obviously you have the balance sheet. You do not depend nearly as much as others on the securitized market to actually sell these loans into. So you are able to lend, so that's positive. But maybe it's also important for our audience to hear that, yes, you are able to do bridge loans. You're very willing to do it. And that also, maybe we can also touch on mezzanine, on JV opportunities. Mm-hmm. But I think it's important also that our audience hears from you that what type of assets and what type of sponsors you're looking for, that these type of loans, as well as JV investments or mezzanine loans, are actually working.
Yeah, I would say that definitely right now on those bridge loans, we're just like what you said, we feel like we're in a great position in that we're able to utilize our balance sheet to place those loans. And if we need to hold them for the full term of the 3 years and not, try to sell them off into the CLO markets, which have definitely been upset the last 6 months or so, we feel like we're in a good position to do that, which has been great. But just what you said, the credit boxes are definitely tighter now than they were probably, 6 to 12 months ago. What we're looking for is deals that probably have more of a direct path to a permanent agency or HUD or other kind of, permanent financing home. Because really, those deals that are going to take the full 2 to 3 years of a bridge term to get there, we're just seeing that a lot of those deals we've got in our portfolio, they hit a lot of hiccups during that term, and they're having more difficulty kind of staying the course, especially here through COVID. And so what we're looking at is, hey, maybe it's a deal that's, had a poor management play and they've let the occupancy fall, but it's still cash flowing fairly decently. It's not, at a 0.5 debt cover and at, 60 to 70% occupied right now. It's something that's more, 80, 85% right now. The sellers have, the management group has let it lag a little bit. And we can just see this market is running at 93 to 95% for this kind of space. We can check comps and see that and see the decline in what's happened there. And if we have a good sponsor that's willing to come in, put some money behind it, we don't need it to be a ton of funds. Honestly, these days, that's one other thing that we're a little bit more less focused on, I would say, is, those big, heavy value add lifts where you're going to be putting, $10,000+ into the deal. That's not necessarily something that we see as a super positive right now, because, there's lots of other issues going on right now, trying to keep occupancies even in stabilized deals today. So really, if you're planning to, hey, the sellers have let things lag, occupancy's down a little bit, it needs a little bit of love to kind of make sure we keep the momentum going on the leasing. That's the kind of deal that we're going to get very aggressive on. Like I said, up to that same 75 to 80% of a cost basis, and with rates that are going to be, in the mid threes or so over an index. So you could have a sub 4%, bridge term to start with here, and run that thing out for a couple of years, and it may work a little bit better to have an agency exit or a HUD exit, whatever your plan is, in about 18 to 24 months versus 24 to 36 months that we were seeing before.
Very good. So is it fair to say that obviously besides the asset, the market that you are considering is very important, as well as the sponsor strength in terms of not just financial strength, but also experience. Right? In the past, a lot of these bridge loans were done, I do not say with Hunt, but certainly with some other bridge lenders, where the experience by the sponsors definitely wasn't there, but they were still able to get bridge loans. Today, I think more than ever, tell me if I'm wrong, the experience by the sponsors is definitely a crucial piece here.
I would say absolutely. I would say that honestly, the financial strength covenants kind of are what they are. There's no set, despite some things you may hear from other, agency folks out there, there are guidelines of what we'd like to see net worth, liquidity, that kind of thing be. There's no hard and fast rules. So, I mean, as long as we've got, as a lender, a good sense of who the sponsor is and what their financial strength is, and we feel comfortable that if something were to happen, that they'd be able to, come up with the funds needed to keep the property afloat and keep the loan going, we can determine that however we see fit, as long as it's within a general range of what the agencies generally see. Our credit folks, even on the bridge side, will follow behind that. Just what you said, the more important thing is experience and showing a track record of, hey, if we're going to do something that's a little bit more outside the box, something that is, going to take a little bit more of a value add lift, or it's got more of a story to it to kind of turn something into a great stabilized property, that's where we're really going to rely on the experience. And so if for your listeners out there, if you've got, a little bit less, this is your first or your second deal, or maybe you've been doing, some duplexes or other kinds of rental properties previously, what you really want to do is go and find a partner for your first couple of deals to say, hey, this person I know has done 3 to 5 deals or more. They've got good track record, especially if they've got a track record in the individual market of the deal that you're looking at. That goes a long way for us on the lending side to say, hey, even though we know these 2 guys maybe, or this one guy doesn't have all, that much experience, he's partnered and there's another, co-guarantor of the loan here who's got really good experience and history. And so he's going to be advising them on that front. They're going to be learning the tricks of the trade here, and they're going to be building up, their knowledge base with this first deal. And combined, they're generally within the range of the financial strength that we're looking for. And then that way on, that deal goes through, hopefully everything goes great. And then on deal 2, 3, and 4, we as the lenders can then fall back on the original, guarantor and say, hey, now he's got 1 deal under his belt. It's been operating well for 12 to 24 months here. Things are looking great. We don't necessarily need to have an additional guarantor brought in if the financial strength is going to be there at that point for whatever the loan size is going to be. So I would definitely say that, in today's environment, partnering with folks who have great experience, but just the experience part of it in general is almost even more crucial than what the financial wherewithal is.
Totally agree. Multifamily is a team sport, right? No questions asked.
Absolutely.
Very good. We know you don't have a crystal ball, but obviously would still like to have your view of what's where we are going over the remainder of this year and then into 2021. Whether you have any kind of snippets that you could share or opinions from your end as well as Hunt.
Yep. What I'd say is we're expecting a very robust end of the year here in terms of more deal volume. Like I said before, the agencies have their $80 billion cap levels. They're not, really close to hitting those numbers. And so we have no indication from the agencies that they're going to be turning, the spigot off at the end of the year, like we've seen in previous years in late November, early December, where they're running up against their cap and they try to push business off into the following year. We're not expecting that necessarily. However, the other part of this is obviously we've got some major milestones in our country coming up. There's an election in about a month and a half that's going to be, if it's anything like the election was, 3.5 years ago, that definitely put the markets into major turmoil immediately thereafter. And so with everything that everyone has seen on the news recently, you never know what's going to end up happening with a major election like that. So what we're advising our folks is, volumes have been very strong, but and so whereas the agencies may not necessarily, have any, volume concerns for the end of the year of getting deals done, what might end up happening is the back end bond buyers, the B-piece buyers and bond buyers who actually, buy into the agency loans, they may start getting a little bit full because there's been so much volume this year. And maybe they start, backing off on the amount of deals that they get involved with. And as a result of that, it could be spreads starting to go up. And whenever there's volatility kind of in the markets in general, whether it be from social unrest or elections or, COVID related, if there's another spike or what have you, all of that could lead to higher spreads down the line. So we don't expect treasuries to go up. We think spreads might go up if some of this stuff comes to fruition. So talk to your lender, get in front of them now as much as you possibly can, and start discussing options. Even if you think a deal is not quite ready just yet, or you're still a little bit early on the bidding process or what have you, go ahead and talk to your lender, whoever that might be, and just talk about what options might be available, and see if you can't start, setting the table for those things to get done quickly. Because, one thing we've seen, Fannie Mae is back with their streamlined rate lock in certain situations for certain sponsors. So if you get a deal in and you get it under application and you feel good that you're gonna be able to get the thing closed, especially on a refinance, today you feel a lot stronger about that. You can actually go in and do what is equivalent of an early rate lock, where you lock in the entire rate shortly after application. I'd say Fannie's looking for that to be maybe not shortly after application as much today, but maybe a couple weeks in, where they've got a really good sense of third parties are good. If you're looking at the green reports are in, stuff like that. But that is available now, where it wasn't back during the COVID quarantine times. And Freddie Mac is doing their index lock again in certain situations as well. So, obviously Freddie Mac still holds their spreads whenever they quote a deal and a deal goes under application. So your spread, you've got a good amount of time. You've got that 45 to 60 days to get the deal done, but you can also go in and just lock your index with Freddie Mac as well on those deals, and make sure that your rate is set and ready to go. So if you've got any concerns about things like that coming down the pike, maybe kind of on the macro level, it's a good time to kind of talk to your lender and see if you can get something put aside.
Great. All absolutely great information you provided us here, Colin.
Yeah, definitely a
thanks
source of wealth of information there, Colin. So thank you.
Yeah, definitely.
Still digesting everything, trying to think about what we're going to go do now business-wise, from all that information.
I know there's so many options right now, and there's a lot of different nuances with everything. So, the best thing you can do is just reach out and ask questions, because, any lender who's worth his salt will know that there's always going to be unique circumstances with almost every single deal. That's never one size fits all. So you always got to know, okay, here's where we think we can push on this. Here's the troubles that we might see on that. And you can work out with your borrowers to find out the best option that works for them.
Yeah, absolutely. And so speaking of reaching out, how can listeners get a hold of you?
You can always reach out. My email address is colin.cross@huntrealestatecapital.com. I've got to go ahead and forewarn everybody here. This may be a market in time, because we just heard yesterday that we're actually going to be rebranding our company into a whole new, probably something short and sweet that's going to have a really sharp bite to it as a name or what have you. So no one knows what it is yet on our end. So I say huntrealestatecapital.com right now, but that could change very soon. So if you ever need anything though, I'm based here in Dallas. Anton has my information. Ferris has my information, and I'm always available. You can find me on LinkedIn. You can find me via email as well. And we're always happy to have a conversation and see what we can do to help.
Awesome.
Very good.
Very much, Colin. Appreciate it.
Thanks again, Colin. It was really great to have you on, and we look forward to work with you for the rest of the year and the years to come. whatever the name may be.
Exactly. We look forward to it as well, Anton.
Yeah. Thank you, Colin.
Thank you. Take care, guys.
Thank you all.